We just got done talking about the intraday trading indicators. So now what we're going to do is this thing is just kind of like going along and developing along. We started off, talking about hardware and software and stuff like that, building a base. Now let's go to the intraday indicators. Now we want to go to the first setup. Okay, so the first setup of the day. So the first thing I want to talk about is gap plays. And gap plays are pretty much, Hubert and I both start off our day the same with the gap play. It's fortunate for Hubert, since he gets up at 9:28 in the morning, that the gap play doesn't start until 9:30.
Y'all are making fun of that? No joke? I get up, if you're in the room, you probably know it, because sometimes I'll oversleep just a little bit. But I will get out of bed at like 9:20, 9:25 sometimes. I'm usually in boxers and a T-shirt, and I'm like wiping the sleep out of my eye. I go, all right, guys, we got a gap here. Buying the Dow Mini. No joke. I mean, because I do my homework the night before, so I don't have to do it first thing in the morning. But for real.
Plus, the gap, in talking about a setup, the gap is a pretty much an automatic play. And part of the reason why, well, there's a couple of reasons why we like using the gap as the first play of the day. The first reason is that a lot of the intraday indicators that we looked at, they don't really all kind of line up and come up until about 15 or 20 minutes after the market's opened anyway. Mm-hmm. All right, so we're just kind of is the process of looking for a high probability play that would happen, first thing in the morning, that we didn't have to really worry about the indicators and stuff like that, and it really became, the gap play. And what the gap play is if you're looking at a 24-hour chart, you're not going to be able to see what the gap is, right? It's 24 hours. You're going to see a constant up buying and selling and things like that. If you have a chart that's set up specifically for gaps, what you have to do is make sure that the times are set up correctly. So on TradeStation, you can just go in and set up like a custom session. And for East Coast time, you start collecting data at 9:30 a.m. Eastern, and then stop collecting data at 4:15 p.m. Eastern. Even though the Dow trades until 5 o'clock, I'm only interested, kind of where all the S&Ps are closing. It's close to where the cash market closed and things like that. So then what happens is if you've got the last piece of data here at 4:15, and then if you start collecting data again at 9:30, and there's your first tick, well, now you've got a 65-point gap, okay? And what's nice about this is it's a very clear, it brings you a very clear exit strategy on your play, okay? Sometimes it takes some guts to get into these trades, especially like London bombing. It's like, wow, the market's opening up lower. But the fact of the matter is, and one of the things that Hubert's going to talk about is the raw gap data, is that regardless of what's going on, regardless of the event, regardless of the reason for the gap, there's a very high probability within the high 70 percentile that these things are going to fill the very same trading day, okay? And then there's a few things that we do to filter it out so it actually gives you a higher percentage, which are some things that we're going to talk about. So not only is it like the first trade of the day, it's also one of the most highest probability trades of the day, and also requires zero thinking on your part. Okay, so you don't have to sit there and decide whether or not you're going to take it. It's just pretty straightforward, which is one of the reasons that I like it too. I'm more of a night person, so first thing in the morning, I don't want to think too much, and the gap play is a perfect way to start off. I found in my experience that gaps, the best gaps are a little over 20 points on the Dow, which is about 2 points in the SPU. In between about 20 to 40 points on the Dow is a really good one. If it gets too high, generally it's going to be a breakaway gap, but there's a way that we can tell with that by looking at pre-market volume, and that's something that we'll also look at too. Okay, and then the way to think of a gap is the gap is kind of like an open window. At some point, somebody's going to come along and shut it. So one question that generally comes up at this point is why indexes and not stocks? Okay. The reason that we do gaps on indexes is because stocks, generally the reason that they'll gap up is that they have some kind of specific news-related item on it. So if you've got Enron gapping down because of an accounting scandal, well, guess what? It's probably not going to come back up and fill its gap. Or, I'm sure Bernie Ebbers wishes that WorldCom would have come back up and filled some of its gap, but, it's kind of a sad case. I mean, and him, ironically, trying to wait for his stock to come back up got him in a lot of trouble. He's in jail for 25 years?
30.
Something like that? Yeah, I mean, gosh, that's too bad.
That's a life sentence for him.
Yeah, he's 63, 68 years old or something like that. Probably a good time to quit smoking. See if we can make it out of there. I mean, that's too bad. But the fact of the matter is that on a stock, gap plays are not as predictable. Okay. Now, if you just like playing stocks, there is a way that you can do it. Is if the stock, let's say that you play KLAC, CLAC, which is a stock that Hubert plays quite a bit. If CLAC gaps up 50 cents and the S&Ps are gapping up 5 points and there's no news on CLAC, then you can use the stock CLAC just as you would the stock indexes. Okay? Does that make sense? What you're looking for is a stock that gaps up about every 10 cents for every 1 point in the S&Ps on no news. All that means is that the stock is gapping up with the markets, and you can play it just like you would the stock indexes. So the reason I like the stock indexes is that generally gaps happen because of some kind of news. And good news for, say, the oil sector is going to be offset because good news for oil is bad news for transportation, things like that. There's always going to be kind of a yin and yang there. So just because what will happen then is that the markets will gap up, they'll open up higher, and then you've got some stocks that are opening up lower. Those stocks will continue selling off. That's going to drag the index down. And then the stocks that gapped up higher are going to have their first pullback. That's going to pull the index down. And the weight of these two together bring the index down to its gap. Okay, that's part of the reason. The other part of the reason is it's kind of a self-fulfilling prophecy. All right, traders since time immemorial that have been watching charts it's something about it. It's a fetish for having clean charts. Okay, nobody wants to have open gaps out there. So if there is an open gap, we gap up, there's an open gap, hedge funds and traders will kind of sit back and wait. They're going to wait until that gap is cleaned up before they come back in and buy. So it's a combination of just market action and a self-fulfilling prophecy as to the reason that these gaps fill. If you're doing, and it sounds like, I mean, people in here really aren't doing anything with stocks for gaps anyway, but if you're doing, like if there's a stock that's gapping up that's not part of a major index, I wouldn't even touch it. Okay, it's just easier, you just focus like on the Dow or the S&P futures, or you can do the Dow, the diamonds or the spiders in terms of ETFs, or just do like an individual stock, like I said, like CLAC, that's gapping up like that. Dink. Also, too, I mean, stocks that are receiving upgrades and downgrades and they're gapping, I mean, that's not a gap play either. Okay. I just went through and just talked about all these, so we'll just keep going. All right, so let's look at an example of a gap play. So what happens here is this is the Dow. You can see here on July 23rd, the Dow closed at 91.69, and then the next morning at 9:30, we opened up at 92.33. That's 64 points. And this is a typical, I guess, gap that'll happen. I mean, the best gaps happen like in 30 minutes and it's done, right? You can move on to the next one. They're not all that easy. This one comes up, it comes down. It gaps up, it comes down, comes back up, takes out a bunch of stops, and comes back down and fills the gap. Again, 80% chance that it's going to get filled in the same day. So one of the best things to do with a gap is you set your parameters and just leave it alone. Okay? I'm going to go over the parameters, but let's look at some more examples. Here's another example. Gap up in the S&P. You can see how far this thing went up against it, and then eventually came back all the way down and filled the gap that same day.
Almost closed right after. It almost closed within a couple of bucks.
Yeah. And what you do on gap plays, too, is if you've got a situation where neither the stop or the target's been hit, and even if it's really close, you just get out of it at the close. Yeah, you're done. Another example here, close here on the S&Ps. We gap up 4.25 points. This is kind of typical. You're going to get in, you're going to take a little bit of heat, comes back down, fills the gap. This is probably the most normal situation I see with the gap. You're always going to be taking a little bit of heat. The times that you're not, it's great, it's a gift. It's just a matter of, how long can you take it, boom, come back down. I mean, this is a pretty good spike here, all the way back up to 980 from there, but, boom, the gap gets filled.
Where was your stop on that?
I will go over the parameters in a second. Yep. Another situation here. Again, this was a big gap up on Fed day, FOMC day. What comes out now, here's where the minutes came out. We shoot up, almost make new highs. It's like, oh, open gap, let's go down and fill that. Fill it almost exactly, bounce back into the close. So it's realizing how powerful these open gaps are. You always want to be aware of where they are during the day, because at some point, remember, the market's got an 80% chance of coming back down. Now, this may scare the crap out of you to take a play like this, okay, and that's fine. All you got to do is just remember, as you're taking your setups throughout the day, remember, you've still got a pretty good chance that that gap's going to get filled. So guess what? Focus on the short side. You know, if you're focusing on the short side, you have a higher probability that your trade's going to work out. So what's happening here, this is like some data that's been recorded in eSignal. You've got, this is the mini-sized Dow, and here we are closing at 415. And right here we just mark the close. And it's kind of interesting on this next day, Intel comes out with some good news. Okay, so this causes the market to get a little bit excited. And we gap up. It's a 47-point gap. So what you do in this play is you're just shorting it right at the open. Okay, this is a non-thinking play. Short it at the open, and you're looking for it to fill this gap. And as the market comes along, it just kind of drifts down. And then very quickly comes down and fills its gap. You know, this is more of this is a pretty easy gap, pretty low stress. I call this a Bahamas gap. You know, you get in, you know, everything's I to E. It's great. And I'm just going to go through it again here real quick without pausing it. So it comes up here, you short it, boom, fills the gap, you're done. All right, next trade. So now,
after it fills the gap,
hold on.
You don't do pre-market?
Hold on. So the very next day, we close here. The next day, IBM comes out with bad earnings. Boom, we come down. We're down like 62, 63 points. So now it's the opposite. We gap down. Doesn't matter the reason. Going long. This is when Hubert wakes up 2 minutes before, rubs the snot out of his eyes, and says, "Going long the Dow Mini. Going long the Dow Mini." Now this is a more typical gap because what will happen here is it tries to fake traders out. Right here, you know, if you're in the gap long, you're feeling pretty good. A lot of times, traders will bring their stops up. Boom, they get stopped out here. This is kind of an "I got you, sucker" trade, and then we reverse and we just kind of go higher. And again, remember the chances of the gap getting filled the same day are pretty high. Boom, fill the gap, you're done.
Yeah, it's not that easy.
The hard part is because people watch it and they freak out and they get out of it, and it happens all the time. So, all right, so we had a couple of questions here, and Hubert has some input on this too. What were you going to say? You were going to talk about...
Do you, once the gap has been filled, do you exit your trade since play your first example again? It went lower.
Oh, okay, so after it's done, after the gap fills, I exit the trade, and then just wait. Do I just keep going short or buy it? Or
if it keeps on going through the gap, and the gap's closing, it's going lower, do you hold for more, or do you close it at the gap?
Okay, so... That's a good question. I mean, if it's coming down, it looks like it's going to keep going. You know, oh gosh, the market's going to crash. Do you stay in it? What do you do? What do you think?
You measure target.
I know you're anal. I know you just cut it loose.
No, hold on. I'm just kidding. This is okay. So what I do is I short the gap up, and it's coming down. And it looks like the market may crash or whatever. We get to the gap fill. I'm out of the whole thing. Okay.
Anal. I have seen him do a gap trade. It'll be a 60-point gap trade, no joke. And it will come within 2 points of filling the gap. And he won't take it off. Where I'll be sitting there going, take it! He'll hold on to it until it fills.
Well, and part of it, too, again, it goes back to when I'm trading, I want to have good data to play with. Okay, At the end of the month, the reason that if the gap's coming down, it looks like it's crashing and it's going to blow right through the gap, the reason I take it is because I want to book it as a successful gap trade, and then all I got to do is look for my next setup. And if my next setup's a short to the pivot or whatever, I'll get in on that. But this way, what happens is by doing the gap trade the same way each and every time, I'll know how successful it was. If I deviate from that, you know, if I'm like, oh, we're 10 points away, I'm going to get out, or I'm just going to hold on to this one because it looks good, now I really don't know how successful the gap play is. But by doing it this way and doing it the same way every time, at the end of the month, I can sit there and go, okay, I have these are the 8 setups that I use, and the gap trades made me X, all right? And I can sit there and go, all right, since I did this the same way each and every time, it made me this much of a profit. There's no really reason to tweak this. If I do it different every time, I'm not going to know that.
You have here in your text best gaps for the E-mini Dow are 20 to 80 points. What's that for the Russell and the S&Ps?
Okay, for the S&P, anytime you see the Dow, like say 20 points in the Dow, just divide it by a factor of 10. So for the S&Ps, that'd be 2 to 8 points. And for the Russell's it's a little less cut and dry. Generally, if the Dow moves 10 points, the Russell moves anywhere from usually about 2/10. So it's not quite as cut and dried, but what you can do in that, here's the shortcut. If the Dow gaps up 60 points, then it's the equivalent in whatever the Russell is at the time. It's going to be about the equivalent. I mean, if the Dow is gapping up 60, then the Russell is going to be gapping up anywhere from like 4.5 to 6. You can still just take it in the Russell. That makes sense? Yep. In my experience, the Dow and the S&Ps generally are a little bit more clean in filling the gaps because they have a broader base. But in general, all four of the stock indexes will fill the gap on the same day. There's some days when maybe 3 of them will and 1 won't. But generally, they'll kind of go in conjunction with each other pretty well. Another question?
Yes. Since you keep track of your statistics, how has the gap been acting over the last couple of months that you've been trading it? Has it still gotten your?
Yeah, it's been good, but we haven't. I'll show you the filter that we use to decide whether or not we're going to take them, and I'll show you that, and you'll see some of that.
When the gap opens, when the market opens, you just short it right there. I mean, you don't wait 1 minute or 2 minutes, nothing.
The question is, when the gap opens, I just take it right away. So here's a difference in Hubert and I styles. For me, I just take it right away. I'm in, I place my parameters, I'm done with it. Hubert, he'll have, because when he gets in, you can talk for yourself, I guess.
No, you're doing good. No, I use a filter, and I'll go through it when we talk about the difference in style. Like John will use a different stop than I will, but I'll use like the TTM trend on different time frames and on a 24-hour Globex chart. So if we're gapping up and the TTM is red on Globex, I know that I've got a higher probability chance of it filling on the 24-hour chart because it's kind of like you're cheating. I'm using the indicator on a Globex, so it's 24 hours, so it's calculating the ups and the downs of the movement where Globex is like that. So I'll use the 1 minute, the 5 minute, the 2 minute, the 89 tick, the 50 tick. If we're gapping up like 40 points and the TTM on all those time frames are red, I'm shorting it. If the TTM is blue on all those time frames, I'm probably going to go with the gap. I'm either going to go with it or I'm going to wait until those colors start to change for me, then short it for a gap fill.
This is stuff we'll show you.
Yeah, it's just an indicator that changes the bars blue and red.
Do I care about the TTM? For the gap play, literally, yeah. For the gap play, I just do the gap play. I watch the TTM, which is right, and the TTM is, if you guys don't know what it is, it colors the bars blue if it's bullish and red if it's bearish, and I use it for different things. Yeah. And we'll talk about that.
Go ahead.
If you got a negative, let's say gap down, and then you went long immediately on open, and then the market internals started turning down, and you got sell signals. Would you stay in the gap?
To repeat the question.
The question is, if you've got a gap down and then you're in the gap, you're still in the trade, and then the market internals tell you to get out because they reverse and say it's going lower. I try to treat the gap just like a gap trade, without any interpretations, without too much. Like if the gap's the gap, it's just a setup. It's a trade that you got to take. It's like the first pitch. You got to stand up there in the box and see what the guy's got. It's just, I don't really pay attention to the internals that much when I'm playing the gap first thing in the morning. I'm not saying I don't pay any attention to them. I mean, I'll look at the ticks. If we're gapping up 60 points and the ticks are at like 1,200, I got to short it because we're at 1,200 ticks and we're up 40 points. I mean, they're probably shooting all their bullets right there at the open, and then it'll roll back over. But that's the reason I use the TTM. It kind of guides me a little bit, so I don't have to think too much in the morning about it.
And we'll talk a little bit about the parameters that we use. We play the gaps differently.
Totally different.
So would it be a good idea to sort of have that as a totally separate trade, maybe even have a separate account to just...
Yeah, okay. A good question is, do you use this as a totally separate trade or what? Here's what I do with this, and I'll do it in the same account. If I take the gap play in the Dow, okay, say I'm short the gap in the Dow, but then I get a long signal against a pivot, I take that in the S&Ps. Yeah. So I can still, what happens is now each setup becomes independent. The pivot play may or may not work out. The gap play may or may not work out, but I'll know on the setup. It's very possible I can be short the Dow for a gap that lasts 3 hours, and during that time I take 2 long S&P plays that work out too. So that's kind of it offsets each other that way.
I mean, is it possible to make money just playing the gap?
Yeah,
absolutely.
I won't. Like when he'll trade it that way, I'll just stay in it, and I'll either scale out or I'll take my butt whooping of 10 points and go on.
I mean, the Georgia lady who does the 100-lot big S&P trades, that's kind of, she does the gap play, but what will happen if it gaps down, she just stays in it the whole day. Yeah. And that's just how she plays it.
So that at the end of the day.
Yeah. But she's using a $250,000 stop. Oops.
I was wondering too, if you played it the whole day, or is there a point where you say,
Oh, that's a good question. I mean, do you sit there and play it the whole day, or I mean, literally, if it's a gap, what I do is there's two. I mean, the two ways I use the gap. One is I do a pure gap play. I put the trade on, I put the parameters on, which I'll talk about in a second, and I'm done with it. I just don't do anything else with it. If I'm still in it at the end of the day and it hasn't hit a stop or a target, I'm out. But in the meantime, I'm doing other plays. Like if I'm in a gap play on the Dow, or an easier way to do it too is you do the gap trade like using like the big Dow contracts, which are $10, and then that won't offset any mini Dow trades that you do. Different things like that. But I'm just going to stay in the gap trade and then just start looking at my other setups.
Do you find that there's any data out there that suggests that the longer time during the day that the gap is not filled, that there's an increased tendency for it to stay not filled that day?
We don't have any statistical information on it. We don't have any statistical proof of that.
Is that feeling that happens? That if it takes too long to fill during the day,
if it takes more than 30 minutes to fill a gap, I'm gone. But I'm totally different from John. Like, he'll stay in it all day long, and I'll scale out of that sucker. If we get half a gap fill, I'm out of 3/4 of my position. But I'm a scalper, so I'm going to do more things. So I'm doing the gap trade. Let's go. We're either working or we're not. Let's go. And I'm scaling out half or 3/4 as soon as we're at a half a gap fill, because that's the highest percentage play.
And the reason I play the gaps the way I do is that gaps were one of my staple trades while I was working in corporate America, trying to figure out if I could do this for a living. And what I would do is in the morning, I would see what the market was doing. I'd place my gap trade in the parameters and go to work, and I'd come back home and see what happened. And I'm like, hot damn, this is working. And what's ironic is when I got out and started trading full time, the first 2 months, I started trying to outthink it, and it was a disaster. So guess what? I go back to the parameters at work.
do gaps have a tendency to fill quickly as opposed to?
You never know.
You never know, but there's something I'll show you guys in a moment how to tell the type of gap it's going to be and whether or not it's going to fill quickly or have a higher probability. I'll show you that in a second. Any other question? Okay. I want to show you guys one more thing here real quick.
Yeah, no. Oh, he's going to do the setups.
All right, here's another gap play example. What happens on this particular day? We're coming along. The market's closed at 10,282. All right, so we close right there. So I'm going to go ahead and mark it. And then overnight, you get the London bombs going off. Okay. So the next morning, the market, at this point, by the time it opens, it's already rallied, but it's still down like 85, 90 points. And the reason I give this example is that so many people get caught up in the reason for the gap, and the reason is irrelevant. Okay, a gap is a gap. So London bombings, surprisingly, was a very low-stress gap trade. It was a very profitable trade. You come in, you take like 20 points of heat, and then just stay in, and it comes all the way back up to the closing price very quickly. And this is a 5-minute chart, and so the gap fills in about an hour. And that's after terrorist attacks in London. So I mean, it's just if you try to outthink this, what happened on this morning? Because I talked to a lot of traders like throughout the day. Hey, what are you guys thinking about this and stuff like that? This morning, like when it gapped down after that, so many people were shorting. And it's like, oh, it's 9/11, no, and those are the suckers who get caught in that trade, and then boom. So the trade. What happens by getting caught in the trade is what'll happen is like, okay. If you're looking at the news and it's like, oh, wow, there's an attack in London, that's bad. So when the market opens low, I'm going to short it because I think it's going to keep going lower. And so a lot of people just jump right into that. And then so you got all these people who are short, and as this market starts rallying, the trade's going against them, and that's kind of why those things fill the gap like that. Gap trades suck in amateurs. You gap up, amateurs are buying it. Gap down, amateurs are selling it. Okay, so you want to do the opposite of what they're doing.
Barring news events, why do you have gaps? Why do these specialists take the market up?
The main reason, the best gaps ever are the ones that gap up for no reason. Okay, because all that's happening is that the guys in the futures pits are pushing up and they're fishing for stops. Best gaps are like 20, 30-point gap ups in the Dow.
The pit guys would never do that. Quit telling stories on them.
Yeah. For no apparent reason, and they're just trying to fish for stops. They're trying to catch people, see if anybody's out there biting. So, it's fishing.
The risk reward, I mean, you say 20 points for the stop, and if it's 10 points gap, you still take it.
No, I'll go over the risk reward in a second.
Okay.
Tim?
Did you play the gap first day after the September 11th volley?
That's a good question. In that case, we did not play the gap because of something I'll show you about called pre-market volume. Okay, and the pre-market volume that day was very, very high. Also, September 11th was an unknown event at that time. Now that we've had a terrorist attacks are now a known event. Okay, the market hates uncertainty. The market is now certain that there will continue to be terrorist attacks in the future, and you can see how the market handled Spain, the bombings in Spain, pretty much the same way it handled the London bombings. Market hates uncertainty. When it factors in uncertain, now it's certain that there's going to be terrorist attacks. Boom. 9/11 was a very interesting kind of. I'm not trying to sound crass. I had people who were killed in that, and people I know that were killed in that. And it was obviously a very terrible thing. But in looking at the markets, you can learn a lot about the markets and how they react in situations like that. And those were times when the put call, it was selling off, and the put call got up to about 1.5. The market bottomed out, smoked higher. Different things like that. Trend got up to 0.7 and started trending low, or 7.0 started trending lower. The market turned around. So it's just different things like that. It doesn't matter what's happening. These readings are all the same.
How can pit traders fish for stops? Doesn't it have to be like the order from the public or from somebody that actually been placed, or they can just?
The question is how do pit traders fish for stops? We're in the pit. I've got 10 contracts I'm going to sell. If you're in the pit, you can sell it. I can sell it to you. That's fine. I'm trying to sell at the market, so you take it at the. You're going to take it a little bit lower each time if somebody's coming in with a market order, so they can trade against each other during low volume times, especially like pre-market, and move the market up and down. 2-3 points on the SPUs, on the S&Ps. They can't drive the market higher like that, but yeah, they do that all the time. They can't do it as much today as they used to because of the advent of electronic trading. But back in the old days before then, what would happen is there'd be 10 guys sitting in a circle, and it's lunchtime, and they're bored, and they drew straws to see who'd get to take the high tick of the day. And so what they do is they just bid it up and down. They just bring the bids up, and then one of those guys would buy it. And then what would happen is the public would see, oh, there's a breakout, and they'd buy it, and then they'd just bring it back down and cover it. So
That's cheating too.
absolutely.
Welcome to trading.
Welcome to trading. All right, so part of the question is how do you tell, I was talking about, 75 to 80% of the time, the gap's going to fill. So how do you tell the 25% of the time when it's not going to fill? And a large part of what I look at that is just pre-market volume. And you can look at pre-market volume in the actual futures contracts. I particularly like to look at pre-market volume in these 4 stocks, even though they're not even part of the Dow, okay? And it's CLAC, KLAC, Maxim Integrated Circuits, MXIM, Novellus, and Applied Materials. And the reason is that because these 4 stocks, they're easily traded pre-market, and by pre-market I mean when the NASDAQ opens for pre-market trading at 8 o'clock a.m. Eastern and up till the open of the regular session. What happens is you've got institutions, hedge funds, retail traders, all actively participating in the semiconductor stocks. Also, it's real money in terms of cash. When people are buying and selling stocks, that's real cash coming in, not necessarily people fishing for stops on margin as they do in the S&P pit or the Dow pit. So what will happen then is that if I see a gap up and all 4 of these stocks, they're each trading under 30,000 shares, I know there's no volume behind the move. Okay, it's like a car going uphill on an empty tank of gas. Okay, it's not going to be able to make it over the hill. So if I see that these stocks are trading low volume pre-market, on these situations, you got about a 90% chance that gap's going to fill the same day, and it's going to fill quickly. These obviously are my favorite gap trades. They're usually the pretty easiest. They're the smoothest. Now what will happen is sometimes you'll get one of these stocks where maybe one of them's trading 50,000 shares, and then the other 3 are trading under 30,000 shares. In those cases, we've got what I call a moderate gap up. And in those days, you've got an 80% chance that you're going to retrace and fill 50% of the gap fill. So if you get a 40-point gap up, you've got a really solid 80% chance that it's going to at least retrace 20 points. So in those days, I'll actually set up my parameters. I'll take half off at half a gap fill. Okay. The third scenario is that one of these stocks is trading over 80,000 shares. On these days, all of a sudden the chance that it's going to be a breakaway gap is suddenly very high, like 60 to 70%. On these days, I don't take the gap play. Okay? Just a second here. So if you've got 10 gap trades in a row, generally you're going to have 3 of them be the low volume gaps, 5 of them be the moderate volume gaps, and 2 of them be the breakaway gaps. Okay? Question?
When you talk about these percentages, is this just observation, or do you have actual?
Yeah, we do actually have some raw statistics that we're going to go over after we're done here. Another question?
Okay. These would be pro gaps you're talking about.
Yeah, well, generally what will happen is like if you've got a professional gap is designed to keep retail people out of the market. What will happen is the market's quiet, then boom, you wake up one morning, you've got a 100-point gap up. So retail people, day traders, they miss the move. And those are generally the start of a pretty big move. Those are not gaps that you want to fade. And you can tell that they're pro gaps by looking at the pre-market volume that takes place before the market opens.
Pre-market volume in the future?
No, just these stocks right here. Yeah.
In those stocks?
Yep. Yes?
Now you have a page just for those stocks and their volume?
Not a big deal. You can see these tabs here at the bottom. So I've got the sectors that we looked at earlier, and then over here it says SSF. That's single stock futures. So what I do is at 9:25 in the morning, I just flip that tab, and every stock that trades single stock futures is on there, and I just sort it by volume. And what I'm looking for are those 4 stocks that I told you about. And then what will happen is at 9:25, it'll show the amount of trades that have taken place from 8 o'clock in the morning up until 9:25 on those 4 stocks, and then that's how I look at them.
I mean, there are other stocks like eBay and Amazon.
Yep.
That might be better proxies than the ones you picked.
They might be. Those are the 4 that I've watched for 5 years, and I will watch. I glance to see what the other ones are doing too. But I've studied those 4 semiconductor stocks. I haven't studied Amazon or eBay or anything like that. But in general, you're correct. I mean, you can sit there. You could probably do an analysis with any stock on that.
I guess you're viewing this as a continuum under 30,000, 30 to 80,000, 80,000 plus, because I notice the text here is different than the text on your slide. You're talking about taking 2/3 of 50%.
Yeah, the texts are different.
You know what? Here, hold on. Let me get to the actual updated one.
Because what you said is more in that order in the last chart that you.
I think he was in the wrong manual.
I'm intuiting when you just try to continue.
Yeah. All right. Hold that thought on the pre-market volume because it's updated. It's on this. I want to keep going in order here, but in general it's the same. Okay. You guys have the updated manuals. This and the slide. I went back to an old PowerPoint so I could use the moving gaps because that wasn't on my other one. So we'll get to that. Yes.
You look at it 9:25?
Yes.
9:15.
Just before the cap, about 9:25 Eastern. And by the way, any times I say are always East Coast, like that.
Real world time.
All right, so we're on page 90. So we just talked about the pre-market volume, which we're gonna see on here again shortly. But I do want to make it a point that when you do get a breakaway gap and the gap doesn't fill on the same trading day, you've got an 80% chance that it is going to fill within 5 to 10 trading days. Okay? So what does that mean? That means anytime you've got a gap that doesn't fill, you want to keep track of the open gap. Because what's going to happen is that's going to act like it is a vacuum and kind of suck prices towards it over the next 5 to 10 trading days. So as an example, on this chart here was a gap, okay? You can see that it gapped up 44 points and kept on going. On this particular day, we had high pre-market volume, so it was a gap that we passed on, right? And then the next day, we had a little 13-point gap, took that one. And then you can see we close here and then get a 52-point gap that fills really quickly. This is another example of a Bahamas gap. I mean, we come down, you get in, you don't really take any heat, and you fill very quickly. They're very nice trades. They make you feel good, no stress. This is an example of what I call a Somalia gap. What happens is you gap up, you take a lot of heat, almost get stopped out, and then come all the way back down and you take it. A lot of traders have a hard time holding through that. So you're taking a lot of fire. Another Bahamas gap up 62 points, come all the way down and fill that very quickly. So now while all this is happening, I'm keeping in mind that we've got an open gap down here right around 93.04 from August 18th. Okay, so we're now at 6 trading days later. So on this particular day, when we slam down and start forming a bull pennant or a bull flag, sorry, bear flag. Slight detail.
Bull, bear, what's the difference?
A bear flag here, which what a flag is, it's just a continuation pattern. If the market's going, it's like a sprinter. A 100-yard dash, you got to take a break before you can keep going again. Anytime the market falls heavy like this, it needs to consolidate and take a break before it continues. So anytime you see a market move up or down and then start doing one of these, it's generally a continuation pattern. So see something like this, you just wait till it breaks down, take a short, and you can use the top of this as your stop. And what's your target? Your target is the open gap. And so on this particular day, it went down another 95 points and hit that, and you're out. And the only reason is being aware of that is you have to be aware of the open gaps that are still left out there. So on a day when the gaps don't fill, I mean, yeah, it's kind of a bummer if you took the gap play and it doesn't do it. But remember, that's setting up a future play, within the next 5 to 10 trading days. Okay. Another example, just to see how tenacious these are. Here's a 61-point professional breakaway gap. Boom, the markets go higher. At this point, the whole idea of this is at this point now, everybody who is waiting for the gap fill to get long starts sucking them in right here. They can't take the pain of not participating any longer. They jump into the market. Boom. We come down. This is an hourly chart. We come down a couple hundred points in 3 hours. Fill the gap. I mean, almost exactly. Right there. We come down just a little bit through it. Then boom, turn around and go higher. Okay, this is like 300 points down, 250 points down, 300 points higher over the course of this is all January and February. So you always got to be aware of the open gaps out there. Okay, that's not an uncommon pattern to see.
Is there no information in what's happening with the futures overnight that gives you any indication what's going to happen with gaps?
Globex.
In other words, you're looking at stocks,
the
volume on certain stocks between 8 and 9:30, but you're not looking at the futures at 8 o'clock in the morning, or are you?
Well, the question is the difference between the stock volume or what the futures. I mean, I'm looking at the futures because I see where they're trading, but there's nothing. Usually the volume's pretty low. I mean, it's low enough that it's hard to actually make any distinction as to what's going on. So I mean, I'll look at the futures in terms of where they're trading. Like, are they trading at a pivot? Something that Hubert's going to talk about in a second. But really, what it comes down to is the pre-market volume in the stocks. It was something I found to be pretty reliable.
You can use indicators on Globex. I mean, you're just going to have to know that Globex, in and of itself, is very choppy, thin market. I mean, a lot of the signals you get in Globex carry over into the day session. I mean, but you can look at it. I mean, you can start looking at it at 8 o'clock, 8:30.
I was just asking if you were looking at any specific things in the Globex market that will give you any indication about the way in which a gap would go when the market opens at 9:30. That was my question.
Yeah, I look at it at 9:28, or 9:20, 9:25. Yeah, but I mean, you can see the color in the Globex. You can see if Globex ran up and put in a top and now is rolling back over. And if it's trending lower. If it's trending lower, if you've got some indicators telling you, it's probably going to trade a little bit lower, then I mean, Globex will give you a little edge, but I mean, it's not going to scream at you and go, all right, this is the one to take.
Yeah, and the answer really is no. I mean, it's what I found, for some reason, I found this with this gap play is that, and I was guilty of this myself, it's one of those trades that everybody looks at it and says, okay, there's got to be a way to make this easier or tweak it and stuff like that. And really, the best success I had with this trade is when I was working full-time. I didn't watch it. I put the parameters on. And then when I tried to tweak it, when I started trading full-time, it just was not consistent. So I just went back to that, and it's a pretty consistent play. But it's just, you just can't think about it. It's like, boom, get in, next. Okay, here's the methodology that I use. So Now, okay, right here, so in your manuals, cross this out. When I have when it says it's over this 80,000 thing, it says 2/3. That should be half. Okay. So I just take half off at that point.
John, depending on the size of the gap, would it influence your lot size?
That's a good question. Depending on the size of the gap, would it influence your lot size? For me, I mean, I'm doing the gap trades pretty much the same. The only difference is if it is something like an 80-point gap with light volume, I'm going to take it. That's going to influence it because if I'm normally, what I'm looking to do is risk, say, I don't want to risk more than 1% of my trading account on something like that. So if it turns out that the stop would actually risk more than 1% of my trading account, then instead of taking it with 20 lots, I'm going to take it with 15 or something like that. And that's something we're going to talk about in the business plan in terms of determining lot size and things like that. Okay, we've talked about this. We've talked about sectors. This is something that I used to do with the sectors, but honestly, I don't do it anymore. So I mean, it's in your manual, and you can make a note on this. When we gap up, I mean, I'm just gonna take it. I mean, for a while there, I was kind of playing around with the sector sorter list, and I really found that there wasn't an advantage in that. So just put an X through this, and just it's just one of those things where I was trying to get cute again and tweak it. It's like, oh, this will make it better. It doesn't.
John, on those single stock futures, do they all normally trade 30 to 80,000, or all normally trade below 30,000?
No, actually, most. And just to clarify, with the single stock futures, I'm not actually looking at the volume on the single stock futures. I'm looking at the volume of the underlying cash stock.
Sorry. Okay.
But
phrase my question.
No. But no, actually, a lot of them will trade nothing because a lot of them are like listed stocks and people don't really trade them beforehand. But those four trade pretty consistently.
So that, I mean, it's not like one's going to be 50 and one's going to be 20 and one's going to be 10 or something.
You could have days like that. And remember, what you do is in that case, if one of them is trading over 30, boom, you just go to the 50% trading methodology. Yeah.
Thanks.
You just take off half at a 50% gap fill.
Are you saying page 95X the whole thing out?
What's page 95?
That was the one you just...
Yeah, exit out. Don't worry about it. For a while, I was kind of playing around with using the sector sorter list to help increase the odds of the gap, and I found out it was a lot of work that didn't add anything to it. So there's no reason to watch it.
You fired that employee.
I fired that employee, exactly. So here's the risk-reward parameters I use. So some of you guys will freak out on this, and so I got a couple of ideas for you, and then Hubert will come in and tell you what he does. But for gap plays, I'm giving it some room. Okay, if we're gapping under 40 points, I'm willing to give it a 1.5 to 1 risk-reward ratio, meaning if we gap up 30 points, I'm going to give it a 45-point stop. Okay, why is that? Because by using that risk-reward ratio, I have an 80% chance of winning on that particular day. Okay. I mean, you do the math. I mean, if you risk 1.5 points to make one with an 80% win-reward ratio, when you get stopped out, you're going to take some hits, but at the end of the year, it turns out to be a ratio of like 68% on your account. Okay, that's the return. The thing, the one change that I will do is if it's over 40 points, I'm going to bring my risk reward down a little bit less. I'm going to do 1-to-1. So if we've got a 50-point gap, I'm not going to use a 75-point stop. I'll use a 50-point stop. All right. So what happens if you look at this and you're like going, John, I never risk more than 10 points on a trade. Are you crazy? You do something like this? Well, if you normally trade, say, 5 lots on a day trade and use a 10-point stop, then just trade 1 lot on a gap play. Now your risk, your monetary risk is the same. The other thing I want to point out is that a lot of times, I always have to get this question, is that,
Oh, cool. Let me ask it. Why don't you risk 1 point to make 82? Or I've always read in the books you're supposed to risk 1 point to make 3-to-1 or 4-to-1.
That's the question we'll always get. And what happens is, and I've seen this before, is I've seen a lot of times it's brokers who are recommending that. And the reason is that if you're risking 1 point to make 3, you're going to get stopped out a lot. Every time you get stopped out, that generates a commission for the broker. Okay, all the people that I sat with and kind of made the jump to trading and learning how to do this is they found setups that they were confident in, and then they gave them room to work. Most of them were using 2-to-1 risk-reward ratios, meaning if they were using, if they were going to try to make 3 points in the S&Ps, they were using a 6-point stop. Okay, but they had setups that had a win ratio of 75 to 80%. So I mean, and that's something that was a big aha for me, is seeing that. And so one of the things I would suggest as you're looking at this, and as we go over the trading plans, is if you've got a setup that you feel pretty comfortable in, but you keep getting stopped out, then it magically reverses, just try reducing your lot size a little bit and giving it more room. Now you're risking the same amount monetarily, but you're actually giving the trade time to work out. Okay? So, I mean, this is kind of how I do this. I treat this position like a kid I'm sending to college. It's like, here's the parameters, good luck. Honestly.
Obviously, you've never had a kid.
Yeah, well, okay. I'll think of a different scenario. But if I get stopped out of a trade, I mean, to me, it's not the end of the world. It's not that big of a deal. It's all about playing the odds. You're sitting down playing blackjack. You're not going to win every hand. And when you're taking a trade, you're not going to win every trade. The idea is that at the end of the month or at the end of the year, you obviously want to have an equity curve that's stair-stepping higher. And I have found that by using a risk-reward ratio like this on the gap play, I've got an equity curve on the gap play that's trending higher. Okay? Easy enough?
Question. In the back.
Yes?
How many times in a row have you been stopped up?
That's a good question. I think the most times in a row I've been stopped out of a gap play, it's either 3 or 4. I think that was the most. And that was before I started using, and I think that was actually what triggered me to find some way to figure out breakaway gaps and how I got into the pre-market volume. So what I found now is that I'll still get stopped out on gaps, but not as many because of the pre-market volume filter.
The other question is, how many gap plays have you had without being stopped out?
The most I've had, and it was actually about a year ago.
No, it wasn't that long ago. Yeah, it was.
Not too.
Was it 11?
There was 14 in a row that filled.
11 or 14, something like that.
It was funny because it was 14 in a row that filled, and then this was like we were in our trading room, and there was some guy in there who'd been watching every gap play. He's like, this is amazing.
Yeah. And then he bitched like crazy because that was the first one that didn't work. I'm like,
well, and what happened is when the one he finally took was the one that got stopped out.
Yeah.
Right. And he'll never use the gap play again because it's like.
You ever play pro gaps on a continuation basis?
Sure. I mean that's kind of a separate play, and how I play it is with pivots and squeezes, which is another setup we'll talk about. The question was, do I ever play, like if it's a breakaway gap, do I ever play the continuation like that? And yes, and we'll talk about that. Yes.
On the previous, I think it said 7 out of 10 people play the gap lose.
Yeah, yes. The reason 7 out of 10 people who play the gap lose is because they use too tight of parameters. Okay? If you don't give it enough room to move, the gap is the scariest trade in the world to play, because what's going to happen is when you take the gap play, you're going to take heat, and it's the best gap. I mean, how I did best in the gaps and how I learned to play the gaps was because I put the trade on and went to work. All right, and then I came home and to see what happened, and there would be times when it's like, God, I almost got stopped out, but it came down and filled it. And I just learned the importance in that situation of just leaving it alone.
People get scared out of it.
Oh, absolutely. I mean, because it's a wide risk reward. You're going to take some heat on it. So, I mean, yeah.
When you went to work and left it alone, did you have both orders sitting in the market?
Yeah. At that point, I was using like a full service broker, so I'd put in my stop and or an OCO target, or he'd watch it for me and stuff like that too.
John?
Yep.
Do you round up the numbers? I mean, let's say the gap is 43 points. How do you set your stop?
No, that's a good question. Yeah, I mean, if it's 43 points, I mean, over 40 points, it's easy because it's 1-to-1. So 43 point stop.
Okay, what if
it's like 38 points and you got to do 1.5 to 1? I mean, if it comes in at like the stop should be 40.5, I'll round it up to 41. So is that what you're asking?
Yeah.
Yeah. Okay. Denise.
One thing that I get in trouble with is when the gap really starts to fill in the 15 minutes before the market opens. Then I get all well, let's see, is it, right when it opens, It turns out to be a 32-point gap, but 10 minutes ago it was a 42-point gap, and then I get myself all.
the easiest way around that, Denise is talking about, is if you're looking at like at a 24-hour chart, you can see that the gap's already filling, and it's like you're missing most of the move. Right. The way around that is you set up a specific gap chart, and you'll see on there, even though you can watch it, pre-market, it's just like you just look at where it opens there, boom, you place your parameters, set it aside.
Because even if it's filled pre-market, it will get filled again?
No. What Denise is talking about is like maybe at 9 o'clock Eastern there's a 40-point gap, and then at 9:30 it's only a 21-point gap.
And sometimes it's a 15 points gap, and then when the market's open, it's just 2 points gap.
Yeah, you don't take a 2-point gap.
Oh, okay. So that's
yeah.
Okay.
I mean, you can say
no gap. The gap was filled in the pre-market.
Right. I mean, 1.5 to 1 risk-reward ratio. Risking 5 points to make 2 on the Dow. Yeah.
I'd do it every time. Every time.
Cost. It's like, hey, I made 2 points. Great. One more, you would have paid for your trade.
That's right.
Right. And a lot of times there aren't. I mean, I'd say of 5 trading days, 3 to 4 days there's a playable gap. There's going to be, one day it's just quiet. There's no gap to play. What I want to do, I think there's like, I don't know how many examples there are, but I just want to go through a couple of them just as some examples, and then we'll go through some of the raw gap data. Just as an example here, you can see here that we come down, we gap up 45 points, and it's a total Bahamas gap. Okay, I mean, there's going to be people who came in and bought this right away. Oh wow, this is going higher. But this was a classic low volume pre-market gap. If this is how gaps worked every time, I mean, this is the only trade I'd ever do. But this is it's pretty typical. I mean, and if you think about it, if you get in something like this, if you get too aggressive of a trailing stop, like right here, and if you got like a really tight trailing stop, you're going to get stopped out like right here and miss the meat of the move. So you just want to, I mean, gap play is just, you just kind of let it go.
So at what point there would you have shorted that? Filled that gap?
At the open.
Right at the open.
Yeah. For me, I mean, when we're open, I'm in the trade. If the pre-market volume met my criteria, I just learned that for me, the gap trade is best when I don't think. I just take it, put the parameters on, and I'm done.
Market order at the open.
Market order at the open. It's 9. It's 9:30. I mean, 9. Market opens. Okay. Yeah. I'm not sitting there waiting. But okay, it's open. Great. I'm getting in. Now, here's an example of another gap trade, okay? So you can see here, we gap down, the market comes back up, we come back down again, make new lows, and a lot of times at this point, I mean, most people get stopped out here, okay? Either they freak out. And this is an example of, if you're in a gap trade and you don't set parameters, you're going to think about it while you're in the trade. I mean, how many people are going to hold on to that through this? Okay, a lot of people are like getting out, reversing, and going short.
I'd already be out.
And I know this. I know this because I spent like a year and a half working in a room with like 100 traders. Like I'm sitting here watching everybody trade, and I can just see you can see what they're doing. And I know when this happens, so many people are bailing out of this. But this is another gap play. You come down, you set your parameters on, leave it alone. There's the gap. Come down, shake everybody out, boom, fill the gap. Okay, so what happens with the gap trade, and the reason it's so scary is that you're going to have wild fluctuations. And what's frustrating as a trader is you're going to sit there and you're going to be up $500, and then you're going to be down $400. And you're like, why didn't I take my profit? But again, the odds are in your favor if you just leave this alone as a gap trade and just let it go. Hard to do, right? And how you can get confidence with something like this is you just trade it, like, again, on something like this, you just trade it with like small, like one lot, try it what it's like until you get comfortable with it. What's going to happen though is if the first play you do gets stopped out, you can't sit there and go, I hate it, I'm never going to do it again. Okay? You got to play the odds.
When you say one lot, you mean one contract or 5 contracts?
Oh, by one lot I mean one contract. Another example here. We open down 51 points. Same thing. You can see that the market tries to rally a little bit, comes back down, but then just continues chopping higher. If you try to play this with too tight of stops and try to get cute, I mean, look at this. We'll go up to 10,120, sell off hard to back to 10,100. If this is a trade where you're watching every tick, you're going to freak out on this and get out of the trade. Okay? Oh, we're coming back higher. Oh, I don't want to lose the profit I've had. Freak out. Again, the gap trade, you just play it by itself and leave it alone. And someone had an idea earlier of just doing this in your own separate account, which is a great idea. Because what you can do, what you'll find, is that you can do the gap trade by itself, but you can still do other plays around this. You'll see other plays that we talk about, squeeze plays and pivot plays and things like that, are all happening while we're doing this. And then you can have the gap play doing its own thing, like in the Dow, and doing these other trades in the S&P, or doing it in a different account, and so on. Of all the trades that we do, or that I do, the gap is the one that I least screw around with. I mean, once it's on, it's on. Another example, this is on the S&Ps. Again, they gap up, short it, comes back down, pops up, scares everybody out who put their stop right above the highs, comes back down and fills the gap. This is actually pretty common. I've seen it so much where people come down here. Either they start shorting here because they think it's going to go, and then they put their stops, or this is a common, I mean, floor traders will look at this and go, oh, everybody's putting their stops above the highs of the day. Let's go up, fish, and see if there's anything up there. Oh, we got it. Now let's fill the gap. Even though it's not fair.
Cheating.
It's cheating. Another example here. Boom, come down.
What's the guys that did the run on Tokyo? What was their rule? What was the guy's rule?
The hedge fund traders in Osaka?
Yeah.
Which one? They had like 8.
What about if you get to the beach? What was it?
Oh, there's a really good book called Ugly Americans by the guy who wrote Bringing Down the House. Ugly Americans is about some hedge fund traders that went to Japan, Tokyo, and Osaka in the mid-90s, and they had some like rules for trading. And they were pretty good. One of them was that you always want to know. Well, I guess they said a different word, but they always want to know who the sucker is. And if you're in there, if you don't know who the sucker is, then you're the sucker. Okay, that was one. The other one was always know your exit point. And then the last one was it doesn't matter. In the end, if you make enough money to retire on the beach, it doesn't matter how you get it. So if they can get their money by coming up here and trying to flush out traders and cheating, so to speak, it's okay if they make enough money in the end to retire to the beach. So that's what you're dealing against. And but it's pretty. What can you do?
So you're out of this trade at 0.3, right?
Right. Out of the trade there, new setups. And right here, and you'll see later, this is a 5-minute squeeze. We actually had a 5-minute squeeze long that developed here, which took us back up to the gap. The squeeze is another setup that we'll talk about. Jerry?
So what if at 0.3 it just tapped it? It just spiked, you got a couple of threads, you didn't get a fill.
That's a good question. I mean, what I'll generally do is for the gap fill, and I guess I should be specific on this. If the gap fill is 10,000, I generally like to get 3 points in front of everything I'm doing on the Dow. When we talk about pivot plays, I'm going to talk about getting 3 points in front of the pivot. It's the same thing pretty much with the gap play. So if the gap's 10,006 and we gap up, then I'm going to be getting out at 10,009. That's actually probably an important clarification I should make there. Does everybody understand that? That's not in the manual. My general rule with trading the Dow is getting in front of everything by 3 points. I'm going to talk about that specifically tomorrow when we talk about pivots, but it's the same thing with the Dow. Denise?
What would you do in the S&P?
The equivalent of 3 points in the Dow is about 0.25 in the S&Ps. Russell about 0.10, 0.10. We'll talk about this more in the pivots, but I'll use it's the same relationship as the pivots as I do in the gap.
And when you're approaching your target, it's minus 3 points. Is that what you're saying?
You want to get in front of it by 3 points. So let's say let's say the gap is 10,006, and we open up at 10,040. Then I want to get in front of the gap by 3 points. So that means 10,009. Okay. All right. So we got that. Go ahead.
You got a gun sign out.
Yeah. I'm sorry, I have a question.
2009, but you will not get in until it hits that. So if it keeps going down to fill the gap, no.
I don't.
No. Tell her where the gap is first.
Okay, hold on.
Use this for as an example.
All right. July 13th, E-mini S&Ps closed at 1114.75, right? So So there we are at 1114.75. We gapped down. I'm going to put a sell limit order on to get out of this trade. So where am I going to put it? Because I want to get a little bit in front of the gap.
You haven't buy it yet, have you?
Oh, yeah, I buy it right here.
Where do you buy it?
When it opens.
1109.
1109.
Oh, I thought what's 3 points.
No, it's for the exit.
Oh, for the exit. Okay. No, I got you.
Got it. Que bueno, eh?
Yeah.
See?
So what I'm going to do is it's 1114.75, then I'm just going to put my sell limit at 1114.50. Okay? Make sense?
See, another one who got it.
Claro. Okay, we got that. All right, let's take a quick break. We'll come back and we'll do one more section today.
Welcome back. We just covered how John trades the gap on the Dow Mini. So I'm going to cover the raw gap data. Am I going to show how I do it too? Is that what I'm doing?
Yeah, what it is you'll do the raw gap data, and then at the end of that, it shows how you do the gaps.
Okay. So now that I know what I'm doing, we can get started. So this is raw gap data off of the S&P minis, or the SPOOs, the minis, not the biggies, all right? S&P. What's a mini? Oh, 105. I'm sorry. 105.
SPOOs are the S&Ps.
I was like, what's a mini? The wrong seminar. That bigger than a 10? You can still use this data for the YM, or the Dow. The average for the S&P is, for every 1 point that the S&P moves, you get about an 8.5 to 10 point move. You can just round it. For every point the S&P moves, the Dow's going to usually move about 10 points, okay? So this gap data was taken from January the 15th, 2002 till February of 2004, okay? I need to update my data, but it's still working fine, so it's not a big deal. Don't freak out too bad about it. There were... Why would that thing not click? All right. So I have broken down the days of the week for the gap probabilities to make it easy for you. All you got to do is take your Post-it note and put down the percentages for the days of the week. Obviously, the best day to play the gap is on a Thursday, okay? Because you've got Monday at 65, Tuesday at 77, Wednesday at 79, and Friday at 78, On average, 76% of gaps fill within the first day, okay? I don't have any statistical information on, does it take 10 minutes, does it take 15? It's just that day, okay? I don't really like trading a lot on Mondays just because I just don't like Mondays. And then by Fridays, I'm usually worn out. Fried. But I'll still play them on Friday. But I'm usually worn out and tired by Friday. Yeah. So the best time that we like to do them is Tuesday through Thursday. But you can play them any day. Just know what percentages it is, okay? So that you know whether you have an advantage or a disadvantage to play it, okay? Now, what size gaps are most likely to close? All I've got here for you is a breakdown of the points on the left, okay? Points on the left with the percentages on the right. Things that you need to know when you're doing statistical analysis is throw out the anomalies where you've got a 17-point gap. It says 100% fill. It happened one time. It's useless. Another one here, 22-point gap, one time. All right. So usually the cutoff is anything below 7-point gap on the S&P is takeable, okay? Does it make sense? Anybody got any questions? So let's say it's Thursday and we have a 3-point gap on the S&P, or it's Thursday and we have a 30-point gap on the Dow Mini. What's the percentages?
82.
82. What was it on Thursday?
82.
What are you going to do?
Take it.
Well, no, take it.
Fade the gap.
Fade
the gap. Yeah, true. But I'm just giving you the supporting statistics, right?
This is not filtered then.
This is not filtered at all.
Right.
Now, if you want to use the way John does it, cool. If you want to use the way I do it, cool too.
You don't filter?
I don't filter it the way he filters it.
Oh, okay.
So what I'll do is I'll look at stuff like this, because I know that Thursday is the highest probability day, that the gaps are going to fill. So if it's like Thursday and low pre-market volume, I mean, you know, it's a gift. I mean, things like that. So I mean, I'm aware of these. I'm still looking at the pre-market volume, but I'm still, you know, aware of the raw gap data statistics as well, assuming that I didn't have the filter. You know, just the filter just kind of adds to it like that.
The reason a lot of people will wuss out on gaps is because they don't understand the statistical information behind gaps. Okay?
Day by day.
Yeah, day by day.
Made by day.
You like stats?
Quit.
Yeah.
This study here, I forget who I paid for to go crunch the data. I didn't physically go crunch this one.
But you did the study.
Yeah. And I physically counted the days on the Forex gap trade for Sundays. That thing's like 83%. I mean, I didn't even hire it out or farm it out to a subcontractor. I actually was sitting there going, okay, Sunday again, you know. So,
Same thing, same principle.
Same thing, yeah.
Fade the gap in the Forex on Sunday.
Yeah, we'll go over that.
Which, yeah, as soon as we get back to the hotel, I'll be fading them tonight.
Right. So does anybody got any questions on this stuff here? I mean, that's pretty basic stuff, but at least it gives you feel better about the statistics now, all right? And you can also, they vary too, like you need to recrunch your data every month or every 3 months, because I'm going to show you another sample that I did from the Dow. I think it's in here. Did you put, is it in here?
Which one?
Let's see. All right, so next slide here. So the next slide here, gap results from 7/10/2003 to 12/3/2003. You see how it's varying a little bit, but it's still working. Just because it's a smaller time series. Okay? So don't let it confuse you too much. If you don't like this one, just go back to the one that I default back to that I use more than anything. I have this one post-noted up next to my screen so I know it. And then I also have this one on my screen. So now I know the day of the week and the percent. Okay?
For the Russell also?
I don't trade the Russell. Sorry.
Those are on the ES, right?
These are on the ES, but you can apply it to the Dow Mini. Just round it, just add 10. What you got?
No, I mean, this is of the Dow, this blue chart.
The blue chart is of the Dow, yes.
So now, what are you saying are the gap sizes that we should take or not take?
On the Dow, I just used the chart on 107. Only thing I did on this blue chart here is I was just showing you the difference on a smaller time series on the Dow, where it will vary from time to time.
The 107 is the S&P.
Yeah, I use page 107 almost all the time.
Oh, okay. So whatever the Dow is, it doesn't matter.
They trade, the Dow and S&P usually dance the same dance and sing the same tune. So if it's Thursday and it's up 40 points on the Dow, I'm taking it. It's an 82 and an 86.
Just looking at the table, I wouldn't take anything larger than a 30-point move in the Dow because the statistics for the percent filled drop precipitously.
Yep.
And you don't have enough data for the large.
Well, what you'll find too is that most of the time the larger gaps also are accompanied by higher pre-market volume. So that's generally what will happen. If you get a breakaway gap, it's generally going to be 50 or 60 points. And so it's also not only supported by the raw gap data, but by the pre-market volume filter too.
Right.
But yeah.
So this is closure the same day, right?
Yes.
So on this table, would you agree that you would not be doing a gap play on a down move greater than 30 points?
On 107?
On the table, 108.
108? Yeah, if you want to use that one. I would just, only reason, I know it's kind of confused people. The only reason I put the blue side in is to show, because this is from 7/10/2003 to 12/3/2003. So it's a smaller data series, okay? I was just showing you that these are going to fluctuate with time, but they still do work fairly accurately.
I mean, and answer your question, yeah.
Right, correct.
So
that's the only reason I put it in there.
So what you're talking about on that last one, are you talking about the Dow or the S&P? Those numbers here.
All right, page 107. Page 107. Page 107 is the S&P. This is my standard one that I always go by. Page 108 I put in to show you that that's a smaller data series. It is of the Dow though. It is of the Dow. I just wanted to show you that it still works, but the smaller the data field, you have a little bit of fluctuation with the gap fields. Okay?
Well, that's actually pretty cool because it says that the more frequent gaps are the better rules to trade.
Correct.
The net points, what's that? The net points you've got there on that 108?
Okay.
Yeah.
Net points.
What's that? The net points.
Nah, hell, I don't know.
No, the net points are, if you took every gap between 11 and 20 points, you'd be up 186 points.
Yeah.
Is that to be used
Per
in
contract.
1 to 1.5 bit?
That's just raw gap data. That's the gap filled, if you would have taken it. Typically, though, on those, and the reason we use the 1.5 to 1 is that they will actually, if they're going to fill on that day, they will stay contained within that. So, I mean, the answer on that would be yes.
That's 1 to 1 then, basically.
Yes.
If a gap either hits your stop or your limit, profit limit, you just close, market on close to allow.
Yep.
All right, on gap data on page 109 and 110, I actually crunched all this data. So I didn't sub it out or get it from other information sources.
Euro?
Yeah, this is the euro, the Sunday gap. Okay? It closes 83% of the time. Okay? We'll go over the gap, the Forex trade later.
Is this the euro?
Yeah. All right, let's go to page 111. All right, is the gap fill more likely on options expiration Friday? Yes or no? No. What's the percentage? All Fridays are 78%. Options expiration day drops by 2%. It's not a big drop, but you know it's going to affect it some. All right, answer is no. Is a gap fill more likely on a Monday following options expiration day Friday? All Mondays 65, it drops by 10% on Monday. So what was Friday? So if we get a 30-point gap tomorrow, what should we be doing? No, we shouldn't touch it. Because look how much it drops. 52%? That's not a real good odd on a trade.
I mean, that's about the odds you get at blackjack.
Yeah,
so if you want those odds, you go to Vegas.
Right.
For the house.
For the house, yeah, exactly.
And these are this is the same data series. It's all statistical information. It's not, well, was it because of Fed Day? It's just whether it happens or not over the calendar period of time. So it's not that it's going to make you or break you, but it's good stuff to know. I should probably stay away from options expiration Monday after Friday, okay? Is a gap fill more likely on a rollover day? All Thursdays are 82%. Rollover day drops almost by 10%. So it's going to be
Do you guys know what rollover day is?
No.
It's every 3 months.
From the futures rollover.
Futures
every 3
rollover
months.
every 3 months.
Okay.
Yeah, that's when you wake up and you do this.
I said, oh, the future change.
Yeah, exactly. Right.
Why did they come up with this rollover?
Huh?
With this
Don't know, man. I don't make the rules.
The question is, why did they come up with a rollover? The thing is about futures contracts expire. I mean, the whole futures industry is based on trying to hedge a price out like 3 to 4 months in advance. So, if you own a stock, you own something that's not going to expire unless you own Enron. But if you own a futures contract, the whole point of it is that I want to hedge these out to June 2005, or I want to hedge these out to October. So that's why they roll over, because once that one expires, then you roll over into the new period of time that you could hedge for. It's built as a hedging mechanism.
And that has this point difference, right?
Yeah, they'll have price differences in the front months or the close months. Yeah.
Yeah, and what happens there is if you've got the June S&P futures and the September S&P futures, the September ones, like in the S&Ps, are going to be 2 to 5 points higher because it's anticipating a future price, stuff like that. So it's not really stuff to worry about it too much.
Rollover day is not the same. Rollover day is not the same as when it expires.
Yeah, actually, that's a good point. I mean, options expiration is the third Friday of every month. And what happens is you always hear about triple witching and things like that. That's the third Friday of each quarter. What will happen is options expiration will be that Friday, but the Thursday before, meaning 8 days before, that's rollover day when you go, like, say, from the June futures contract to the September contract. It's probably the most confusing time to trade because you got to reset up pivots. Word of advice on stuff like that: I know a lot of professional traders who, on that rollover day, they go play golf. And it's a good thing to do. Does that make sense to everyone for trading? If you're newer and not sure, don't worry. It's not something to worry about right now. But if you are trading futures actively, that's something you just want to be aware of when the rollover day is. And all that means is that all the volume goes from the current contract into the new one. If you're confused, you just put up the current month, and the next month you're going to see all the volume in the next month.
Yeah, it makes it easy.
Okay.
All right. Is a gap fill more likely on a Friday after a rollover Thursday? All Fridays are 78%. Drops to 63. Just stay away from it. What is the probability of a gap closing on the first or the last day of the month? Without cheating, because I know you guys got manuals. Which way you guys think, just off the top of your head, will fill the gap better? First day of the month, last day of the month? Yeah. Last day of the month, 84. First day of the month, 56. Okay?
Why is that? Is that just
I have no clue. I have no clue why it happens. I just know it does.
What about the start of the quarter? That would probably
Start of the quarter. We actually don't have data on that.
I don't think I've got any.
That may influence the first day of the month because
It could.
you're taking in all the quarters and you can students.
Yeah, that'd be a good one to look at.
You're still booking profits every month on a monthly basis.
Yeah.
You're a corporation.
Right.
Big traders. So yeah, they want everything cleaned up at the end of the month.
Are the large gaps worth fading, or are they just too risky to take? All this is going is I just optimized the data so that you could see what the optimization was. If you use a half a point stop on the S&P on that data series, you got stopped out like every time. Okay. If you use the optimal one for that data series, I think was a 25% stop. Okay. I do not condone or like optimization curve fitting. I think it's bogus, but I know some people that like to crunch numbers like them, so there they are. All right.
Click it again.
Oh. What is the probability of a gap filling if the gap is larger than the previous day's range? Okay, 35%. All right. What's the probability of an extreme gap filling? You don't really have to pay attention to that, and it's not that important. On page 118, the bottom one. This is the best slide in the whole bunch, and it's my favorite trade. It's an 80% gap fill on half a gap fill.
And this is on any gap.
Yeah, it's on any gap. So let's say we're gapped up Thursday, 30 points, and where is the best trade to do? 15 points from the gap fill. Okay? I'm out of 3/4 of the trade by the time we hit 15 points from the gap fill. Because it's an 80, 80, 80. It's my favorite trade is a half a gap fill. I want to be out of the gap play 3/4 of my position by the time we hit half of the fill. Okay? Now, John has not went over pivots yet, but this is some good information on regarding how pivots work and the gaps, okay? So it'll make more sense when he goes over pivots and how he plays them. But the best pivots to take if you're gapping up or down in a market is the pivot, the central pivot to R1 is 82%, and the pivot to S1, okay? And then it starts dropping off, all right? Don't pay any attention to R3. It's an anomaly. It happened one time. But those are your two numbers. Pivot, an R1, or pivot, and S1, okay?
It doesn't matter if it's above or below the pivot?
No, it's just giving you a percentage. Actually, yeah, by a little bit, 4%.
These pivots over the past year or so, different people can have different pivots, even though they're all supposed to be calculated to some degree.
There's nothing magical about pivots. All it is a line in the sand, and you saying, you cross it, we're fighting.
Well, you're right. There are a couple of different like pivot formulas to
There's
use
like
and
three,
things like
right?
that. But I've watched pivots for like 10 years. And we'll talk about pivots tomorrow. I'll show you the formula that I use, the time frame that I use. I have found that
the
works.
same one if you punch on e-signal and it says put the pivot lines in, it'll put the pivot lines in.
Yeah.
Well, not really, because what e-signal do will give you the high-low close of the regular the like cash stock session, and what I'm looking for is the Globex high-low close. 24 hour.
That makes
yeah,
a
but we'll
difference.
go. But that's something that we'll go over
I just
tomorrow.
can't use everybody's pivots, and I'm a resistance support trader, and pivots screw me all up.
Main thing is if you're going to do one, main thing to do is if you're going to use one and stick to it. Don't like change. Oh, damn, that guy's pivots worked today, and then this guy's didn't.
Right.
Stick with yours. Just say, well, mine just didn't work today. This is how I play gaps, and this is one of the tools that I use. We have it for TradeStation. We have it for eSignal. If you don't have TradeStation and eSignal and you have like a different chart vendor, there's tons of places to get this. It's called the Hakanashi. All it is a Japanese charting methodology. It takes the average of the previous 5 or 6 bars, and as long as that next bar is closing within the top 50% of the range, it stays that same color.
I would just call it Heineken. It's just easy to remember.
It's called a Heineken bar. So it's like playing quarters. It's really easy. It's a simple concept. It's just as long as the previous 5 or 6 bars are staying in the top of the range, they stay the same color. If the next bar trades in the lower 50% of the previous 5 bars, it changes colors. All right?
It changes to
But I
different
called
colors.
PlayStation and they don't have it.
You're right, they don't, because we built it.
All right, so we call it the TTM trend. I just hired a programmer to do it, and he programmed it up and put our name on it. So here's a 5-minute candle chart. I love candles, so don't think I'm beating up on candles. Now, here is a chart of the TTM. Which one's easier to look and tell what the market's doing? The candle one or this one?
The end is more persistent.
Well, yeah, it's got more blue than, because a lot of people will go, oh, God, it's going up. Oh, no, it's going down. At least through this move, this thing stayed blue the whole way.
You can't see the color with the sun. It's the cross.
It should be in your manual.
Yeah, it's in your manual.
Page 126.
So does everybody understand how it works?
Yes.
You don't really have to understand how it works. All it's doing is taking a range. And as long as it keeps closing up in that upper range, it's staying the same color.
So like right here, what's happening on the candlestick, you can see you've got a couple of big red, like bearish engulfing bars, but the TTM, the trend is staying blue, which is bullish the whole time. So it's not getting shaken out by stuff like that. That's the whole key with the TTM thing.
Right.
It's interpreting candlesticks, but it's doing it in such a way so you don't get shaken out of stuff.
So it's taking the high low of the past 5 or 6 bars, you said?
Yeah, pretty much what it's really doing mathematically.
The upper 50% of blue.
It's going like this right here. It's going 1, 2, 3, 4, 5. This bar here closed in the lower 50% of the previous range average of these 5. That's all it's doing. It's no magic or trickery or anything. All right. So now this is the thing I use when I wake up in the morning. I have this on a Globex chart. All right.
It's if you wake up.
If I wake up. So now here's a 2-minute chart of Globex. So 24 hours. Here's a 2-minute chart of a gap. A 9:30 open, a 4:15 close. Okay. Now here's the tricky thing. When I woke up in the morning at 9:30, this is what I woke up to: a red bar. So I shorted the Dow Minis. Did it work down here? Did my play work down here? Did my play work?
You shorted at the arrow?
No.
I shorted at the arrow.
After the first red
Well,
line,
wait.
right?
First red line, yes.
It looks to me like I'm short there.
Who's on first?
Look
No, I didn't.
on this right here.
I'm not
On this right here.
I'm looking at that. Well, answer the question, the first question.
Yeah.
That arrow right there, if
Yeah.
you shorted that, and you closed it out then at 103.66, you would have come out.
Right.
All right, so you should have shorted it.
I did.
Good.
Why did I cover it
Somebody
here?
was arguing.
50%.
I was out of 3/4, and then after I'm out of 3/4, I move my stop in. Okay.
What was the bottom chart again?
The bottom chart's just a 9:30 open and a 4:15 close. In the 2 minutes. All I'm showing on this chart is the gap, so that you can see it easier.
I wasn't looking at the session.
One's Globex, one's a gap chart.
Okay.
Does that make sense? You guys understand why I shorted the gap? No. Because look here, look at this right here. Do you see these? Put a box around this right here. So all I did is look. We had more red than blue, and then on the open it turned red again. So for me, it's a small gap. It's not a huge gap. I don't know what day it was, but it wasn't that big. And then the TTM's going, you should be okay. Take the trade. Okay. So that's how I do it. I don't look at John's stuff. volume.
It's not
just
the
different
volume. It's the pre-market volume.
Pre-market volume. Anyway, all right, does everybody understand? Well, I'll go to the next one. All right. Now on this one, when I woke up, this is what I was looking at. Should I have shorted the gap or not?
Yeah. Sure.
Did it work?
Yeah.
But you have more blue than red.
Probably should have gotten a...
Yeah, within that box, there's more blue, but what I'm looking for in the morning is a color change when it shifts. Okay?
Oh, color change.
Yeah. Do what?
That's all you can see it better, you know, you just
That's right. Yes.
Are you marking
Everything's
with a
looking
color shift toward the open?
Yeah. And I'll look at it. I'll say, okay, it's ran up. There's the high on Globex. Here's the low. I'm just trying to see right at the open which way the momentum is shifting. Okay? Because this thing takes an average of the past 5 or 6 bars, and you can mess with it in the indicator. There's a setting. You can go 3 bars, 2 bars, 5 bars, 20 bars. Whatever average that you want it to take, you can set it up. I mean, you can mess with it if you want. So, all right. So shorted the gap. Did it feel?
Yeah.
All right. All right, so now here's a real-world example, okay? Here's a gap on 622, and then all I've done, you can't really see it on this chart because the projector washes it out, but can you see right here, I've got it, this is called a pointer tracking tool in TradeStation. At that line, at that particular time, what color are the TTMs at the open? Blue. So as long as they kept going blue, I stayed away from shorting the gap. As soon as they change colors, as soon as I start seeing the colors shift in them, then I can short the gap. Okay?
And you would be in long time ago.
Does that make sense?
Yes.
I just, I'm short.
You shorted it after it's run.
Now the difference here is Hubert is getting in. He's only willing to risk 10 points.
That's why I have to do it.
Okay, so I'm willing to give it 1.5 to 1 and leave it alone. So Hubert it has to be very precise in getting in. I'm willing to just do it and let it go. So that's why we do that differently.
Does that make sense? All right. Anybody got any questions? Yes. Okay.
When you look at the color change, you're looking at the Globex session.
Yes. These are all 24-hour time frames. Globex. This is 9:30 open, 4:15.
Is this part of the program that you purchased when I purchased all of these?
The indicators?
Yeah.
Yeah, it's just called a TTM.
Yeah, okay, but I deliberately wanted to come to the seminar before I put them on a computer because I don't want to listen to
it's part of it.
Is there something that would have made you change your mind and seeing as bars are blue and saying, okay, this ain't just going to go on off, I'm going along?
Yeah, okay. So, like, not my personal style, but I mean, if, you could go with the gap on this one and scale out. I mean, you could go with the momentum. It went from here to here. I mean, that's a decent run. I mean, it's not a ton of points. You're getting probably maybe 10, 15, 12 points.
Yeah, but that's if you pick the top. I mean, the problem is you can't target that move.
Exactly. Just not my style. I mean, the best scenario for me would be, if the ticks were like 800 or 1,000 or plus 1,200, and then I also start seeing some change in the TTM color.
And remember,
so
part of the whole key to doing this for a living, okay, is you're not worried about catching every move.
Yeah.
You're worried about catching a couple of high probability setups. So just because the market goes higher on the gap, remember the probability that it's going to come all the way down. So you're going to sit there and try to get the 10 points up on the up move and then try to time it perfectly and come back down. That's what amateurs do.
It's too hard to do.
You have to get specific setups.
Your other statistic that you just gave us a few minutes ago that you trade on that, you could have shorted that gap opening instantly, taken 50% of what the difference is, and you got an 80% chance on that trade of the close, and it went 100%. But you could have been in and out and left 50% of it in there to run the rest of the way. That's
bingo.
Bingo.
Yeah.
Worth the price of admission.
Okay.
In its time.
What are those numbers again?
Which numbers?
What Bob's talking about is that if instead of trying to screw around and you're going to try to catch the 10 points up when it gaps up and then try to catch the move down, we've already got stats that say 80% of the time when the market gaps up, it's going to at least fill 50% of the gap fill. So you don't screw around with it. You just short it, place your parameters, and leave it alone. You don't try to catch every little move and every little tick and stuff like that. So I mean, to emphasize here, literally, and this is from experience, just watching hundreds of traders plus my own trading experience, is that if you sit there and try to catch every up move and every down move on this, I guarantee you by the end of the day, you're going to be down. Okay? Looking for 2 or 3 good setups to catch some of that move, and boom.
All right, so here's how I manage the trade. I use a 10-point stop on everything for the next 4 days. Please, God, do not ask me what my stop is. I use a 10-point stop on everything. On the Dow Mini, on the E-minis, on the Dow E-minis. On the S&P, it's a point, okay? I don't trade the Russell. So if you go, hey, so what's your stop? Whatever my entry is, minus 10.
My stops generally are not quite that tight. Usually for me, I'm using a 20-point stop on the Dow. On the other setups that we're going to be talking about, if there's some special circumstances, maybe 10, but in my experience, I give it a little bit more room. Hubert's more precise in his entries. I'll just kind of get in on something and then let it go.
Here's why the gaps work. My little 9-year-old daughter has saved me gobs and gobs and gobs of cash. Every summer, my wife's family, we go to the beach and spend a week at the beach with the kids and the mother-in-law and the brother-in-laws and all that good stuff. My 9-year-old and my brother-in-law is, how can I say it?
Your brother-in-law.
He works for a company that is publicly traded, okay? And he thinks
he's smart.
He thinks he knows how to trade stocks, okay? So we have a running bet, and we've had it for the past 4 or 5 years. My daughter competes against my brother-in-law, and they just wake up in the morning.
How old's your daughter?
My daughter's 9 years old. Now, here's the thing. My 2 daughters are actually trained. Like, if I'm not out of bed, CNBC is in the great room, and they'll come in and say, Daddy, we're up, so we sell them, right? And I'm like, yes. And no joke, like sometimes they'll come in and say, Daddy, it's down, we buy them, right? And I'm like, that's right. Just because I know that the gap is a counterintuitive opposed to what most investors think. So my actual 9-year-old competes against my brother-in-law. Whoever loses has to buy the entire family dinner the last night out. I have never had to buy the last dinner yet. Because she smokes him every summer. But he's figured it out. Last year he's like, she's just doing the opposite of whatever we are in the morning. I'm like, really? But because he thinks, oh no, we're up 30 points, my portfolio's doing good, we should buy some more. And Mackenzie goes, no, we sell them today. So it works every time on him.
Part of it too on these setups, if it's a setup where if you can't explain it to like your 9-year-old child, it's too complicated.
Yeah.
It's got to keep it pretty simple, and if you can teach a 9-year-old how to do it, then it's a good way to go.
Yeah, and if you can teach your kids how to trade, it's the best profession in the world. No matter where you're at, you can do it. And no matter what your degree or profession is or avocation, wherever you're at, you can trade a market. The only bad thing is, and it's got me smacked one time, is my office is right next to my son's playroom. And my son is 4. So I usually have pit noise popped up pretty high. So I'm sitting there trading, and all of a sudden, I get a smack to the back of the head. Wham! And it's my wife sitting there going, come here, look at this. This is getting to be ridiculous. I'm like, some kid messed something up. So I get up and walk around, and my little boy is playing Hot Wheels cars, going 20 bid by a half, 20 bid, because he can hear it through the wall. He can hear it through the wall. Swear to God. And I still do it in the room. I'll have him come in. I'll say, come in here, let's work with Daddy. I'll say, read off pit noise. And he'll just he'll spit right back out what the pit guy's going. 20 bid, 20 by a head. Locals offer out. It's hilarious. Look,
we got to film it.
We got to film it. It's hilarious. It's perfect. So now here's how I manage the trade. 10-point stops on everything. Okay? I want to be, I sell half. If the trade goes in my favor, I sell half when I'm up 10 points, okay? It does vary depending on what the market's doing. Sometimes I cut these targets off in half. I'll go +5 and +10. But the main base of the operation is sell half at +10 if it goes in my direction. I move my stop from my entry -3 then, where it was initially -10, okay? So I'm selling half, and then my stop is entry -3, okay? If trade continues to go in my direction, I sell a quarter at +20 and move the stop to break even +3, okay? The last quarter of the trade, is my reward for doing everything mechanical, for sticking to my rules. I can flip a coin and exit now. I can do it on tick extremes, pit noise, pivots, fib clusters. Whatever reason I want to do to exit on the last quarter, I can. Okay, it's my reward for sticking to the rules and doing it mechanically. For my position trades, yes, I do get stopped out 10 points. It's not that big of a deal. I have a fail-safe rule that if I lose 3 consecutive trades in a row, I'm done for the day. I don't mess around with it the rest of the day. For one, I'm fighting the market, or my stuff is just not working, or I'm out of I'm not reading something right, and market's moving one way, and Hubert's not picking up on it. So strike 3, I'm done. And it happened, when did it happen this week? People in the room, Thursday. I made money on Friday. Thursday, I had whiff. Just sit down for the rest of the day.
I was at the Traders Expo in the middle of a talk, and my phone rang. I was actually just getting ready to do a talk, and he's like, dude, I got stopped out 3 times. I don't know what's going on. It's like, it's okay. You haven't. That's like happened in a year. He's like, okay.
I hadn't had to set out a day in like 2 or 3 months or something like that. So I mean, it does happen. It's probably longer than that, a little bit.
Hubert, I think he said that he uses a stop of 1 point for the S&P.
Yeah.
Is that then perhaps the reason you don't like the Russell? Because you probably have to have a smaller stop?
You know what? I actually traded the Russell Thursday for the first time in my life.
I didn't move the opposite of the
No. And you believe it or not, I had 2 winning trades in the Russell. That's the only time. As soon as I got stopped out, I was like, son of a, yes. And I was like, you know what? I have never ever traded the Russell, and I hear a lot of people talk about it. So I was just trying to scalp the Russell. I've never. Thursday was the first day I ever traded it. To tell you the truth, I mean, I've heard that it's a nightmare to get good share size in on the Russell. So my personal stuff, I will do in the Dow. I like the way it moves. It fits my personality really good with the ebbs and flows, the way that thing continues, retraces and stops and works out. The Dow Mini fits me like a glove for my style. The stuff that I have to do bigger size in, I will use limit orders on the S&P on. Okay, for like the managed stuff, I'll do in the S&P, but I have to use limit orders. In the Dow, I use all market orders because I'm sitting there just going ding, 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 market in, market out. So yeah. My charts are gone.
Really?
Yeah.
Sorry?
What is your stop on the S&P?
Well, generally, it depends on the setup, but generally, like on a setup that's not, let's call it, not the gap. Generally, I'm using, like on pivot plays and things like that, a 20-point stop in the Dow, so that's the equivalent of a 2-point stop in the S&Ps. And generally, that's kind of my default stop.